For decades, there's been this one single golden rule for retirement. You've probably heard of it, the 4% rule. It was pretty much gospel. The idea was simple. Just withdraw 4% of your savings in your first year and boom, you're set for life. Simple, right? Well, what if that simple rule is now dangerously out of date?
Because here's the really uncomfortable truth. If you follow that same trusted advice today, you're creating this bizarre paradox. You either end up needlessly hoarding your money, like dying with more than double what you started with, or you risk running out of cash completely. The one strategy that was supposed to give us certainty is now a total gamble.
I mean, how did retirement's North Star suddenly become a broken compass? That's exactly what we're going to break down right now. You see, the story of the 4% rule is really the story of a financial world that has completely changed.
Okay, let's dive into it. To really get why it's broken, we first have to understand what the 4% rule was even designed to do in the first place. What was its original promise? So picture this. It's 1994, and a financial planner named William Bengen crunches a ton of numbers. He looks back at the absolute worst market periods in U.S. history. We're talking the Great Depression, the stagflation of the 70s, all of it. And he found that if you took out 4% in year one and then just gave yourself a little raise for inflation each year after that, your money would almost certainly last for 30 years. It was basically a worst-case scenario survival guide.
But here's the crazy thing about that worst-case plan today. A retiree following that exact same rule right now has a 57% chance of dying with more than double the money they started with. I mean, think about that for a second. That's not a success. It's a massive planning failure. It means you could spend years, maybe even decades, pinching pennies for no reason at all.
So here's the crucial point. The rule itself wasn't wrong. It's just that the world it was built for, well, it's gone. The entire financial game board has been rearranged. And this right here shows you problem number one, valuations. See, the 4% rule kind of assumes history will just repeat itself, but your starting point matters a lot. Today, stocks are just way more expensive compared to their historical earnings. This chart shows something called the Shiller-Cape ratio, and when it's high, like it is now, future returns tend to be a whole lot lower. It's like this. Starting your retirement at the top of a mountain is a very, very different journey than starting down in the valley.
The second big hit came to the safe part of your portfolio, your bonds. For decades, bonds were the reliable workhorse, They just kicked off a steady stream of income. But over the last decade or so, interest rates just plummeted. Suddenly, your safety net was generating next to nothing, and that forces retirees to sell more stocks to pay the bills, which is exactly what you don't want to do in a down market. And finally, the biggest change of all? Well, it's us. We're living longer. The 4% rule was built for a 30-year retirement. But today, if you have a healthy 65-year-old couple, it's pretty likely one of them will live into their 90s. That means their money needs to last 40 years, maybe even more. The rule's timeline is just too short for how long we live now.
So, okay, if the old static rule is just too rigid for this new world, then what's the answer? Well, the solution isn't just another fixed number. It's a whole new way of thinking. We need smarter, more adaptive strategies.
The modern way to do this is to be dynamic. Instead of just setting your spending on autopilot and, crossing your fingers, you build a system that can actually react. Your withdrawals need to be a dialogue with the market, not a monologue that just ignores whatever's happening. A great example of this is something called the guardrails method. It's actually super intuitive. You start with a withdrawal plan, but you set boundaries. If the market goes on a great run and your portfolio shoots way up past a certain point, hey, you give yourself a raise. And if a bad market hits and your portfolio drops below your lower guardrail, you tighten your belt just a little bit. It's a simple system for making smart, emotion-free adjustments.
Now, beyond just how you withdraw, there are these two incredibly powerful levers most people have that can completely change the retirement equation. I like to think of them as your financial superpowers.
First up, Social Security. And seriously, delaying when you claim is the closest thing to a free lunch in all of finance. For every single year you wait past your full retirement age, all the way up to 70, you get a guaranteed 8% raise on your benefit. That's inflation adjusted, and it lasts for the rest of your life. It's the difference between your benefit being a slow trickle at age 62 or a powerful fountain at age 70. It's not just an investment, it's longevity insurance.
All right, the second superpower is turning a portion of your savings into a guaranteed paycheck for life. This is done with something called an annuity. What you're essentially doing is transferring the risk of living a really, really long life over to an insurance company. And the math here is pretty stunning.
Right now, a 65-year-old man could turn a chunk of his savings into a guaranteed lifetime paycheck of 6.8% per year. Now compare that to a safe withdrawal rate from a portfolio, which might be closer to 3.5% these days. You're nearly doubling your secure income. For covering your essential expenses, man, that is a complete game changer.
So what does this all mean? Where does this leave us? It means we have to move past this idea of searching for one single magic number that's going to solve retirement for everybody.
Ultimately, it really just comes down to this. The new rules are about building a resilient system, not just blindly following a rigid one. So, number 1, your plan has to be flexible. Number 2, valuations matter. You can't just ignore whether markets are cheap or expensive when you start. And finally, number 3, your plan has to be personal. It has to be built for your life, not for some historical average.
Look, the 4% rule gave us a great starting point, a really valuable framework. But relying on it blindly today is like trying to navigate a new city with a 30-year-old map. So the real question to leave you with is this: is your retirement plan built on the assumptions of the past, or is it actually ready for the realities of the future?